Assalamu alaikum everyone, and welcome to day 2 for P2 revision session. Today is 22nd August 2017. I'm your trainer Hamza Abdul Haq. Let's start with today's plan of action, and today's main standard that we are going to cover is IAS 32 and IFRS 9, which is also known as financial instruments, and this is one of the most difficult accounting standard in the accounting history. So we are going to start till 7:15, and we will be taking a short break for namaz, and then we'll be resuming continuing the session till 8:45 probably. We will try to cover till 8:45, although we are always late. So we will be ending at 9 after taking your questions. You people can also ask your questions in the midway through. So I will be looking for your questions meanwhile. Okay, now let's start IAS 32 and IFRS 9. We are starting with IAS 32. And this is the definition of a financial asset. Now, what is a financial asset? Financial asset is cash, irrelevant of in which currency it is. If the cash is in dollars, rupees, pounds, euros, cash is a financial asset. Equity instrument of another entity. If I have an equity instrument of another entity, for example, I have ordinary share capital of another entity, or I have irredeemable preference shares of another entity. So these both type of instruments will be treated as a financial asset for me, for the purchaser, for the owner. It is an equity instrument of another entity. Therefore, it is a financial asset. Similarly, contractual right to receive cash or another financial asset. If I have a right to receive cash, for example, I have trade receivables. So in trade receivables, I sell goods on credit and I have a right to receive cash. Therefore, these receivables are also treated as a financial asset. Similarly, if I have bought the loan notes or debentures or redeemable preference shares of another entity, these instruments will also be a right to receive cash for me, because if I am purchasing the loan notes, I am giving loan to another company. If I am purchasing the loan notes, I am giving loan to the other company. So for purchaser, these are a financial asset because the purchaser has given the loan and the purchaser has the right to receive cash. So whenever there is a right to receive cash, we treat it as a financial asset. And plus contractual right to exchange financial assets or financial liabilities under terms potentially favorable to the entity. A contract where the company has a right to exchange financial assets or financial liabilities under terms potentially favorable to the entity. This point actually includes or mainly relates to the derivative contracts. For example, if I have a forward contract, with a bank that I will purchase dollars for, let's suppose, rupees 105. I have a contract with a bank that after 2 months I'm going to come and pay 105 rupees and get $1. So this is a forward rate agreement for me. Now what will happen? Let's suppose after 2 months the spot rate of the dollar becomes 110 per dollar. The spot rate after 2 months is 110 per dollar, and my agreement is that I'm going to buy the dollar for 105. Now what will happen is after 2 months I'm going to pay 105. I'm paying cash 105 rupees and I'm receiving $1. Paying 105 rupees, receiving $1. Both are cash. So this is an exchange of financial assets where I'm paying 105 and I'm receiving a dollar of 110. I'm paying rupees 105 and receiving $1, which is of rupees 110. So this exchange is favorable for me. I'm paying 105 and receiving 110. So this contract is a derivative contract, and because there is an exchange which is favorable for me, this contract, this forward contract, shall also be treated as a financial asset. Similarly, if I have futures, if I have options, if I have swaps, all these financial instruments will also be treated as a financial asset if they are favorable for the company. And if they would have been unfavorable, it would have been treated as a financial liability. So if the exchange is favorable, financial asset; if the exchange is unfavorable, financial liability. So financial asset is cash, equity instrument of another entity. If I have bought ordinary shares or irredeemable preference shares, they are a financial asset for me. Right to receive cash, receivables, loan notes, debentures, redeemable preference shares which have been purchased by me. Right to exchange financial asset or liabilities which are potentially favorable for me. So these are the 4 types of financial assets that we have studied here. And the last point, we are going to discuss this separately in a new slide. But first we will be going through the definition of a financial liability. Then we will be looking at this point again. So moving forward onto the definition of a financial liability. Financial liability is a contractual obligation to deliver cash. Financial asset was a right to receive cash. Liability is an obligation to deliver cash. So this would include the payables, trade payables. If I have bought the goods and I haven't paid cash yet, that amount is a payable for me and shall be treated as a financial liability. Similarly, those loan notes, those debentures, and those redeemable preference shares which I have issued will be a financial liability, because issuer is the one who raises the loan, who receives the loan, and purchaser is the one who provides the loan. So who is providing the loan has a right to receive cash, and the one who is receiving the loan has an obligation to deliver cash. So for issuer, these instruments are a financial liability, and for the purchaser, these instruments are a financial asset. Similarly, contractual obligation to exchange financial assets or financial liabilities under terms potentially unfavorable to the entity. The case where the exchange is unfavorable is treated as a financial liability. So this point covers the derivatives. Which derivatives? Derivatives which are unfavorable for the company. So an exchange where I am at a loss is a financial liability for me. The exchange where I'm at a gain is a financial asset for me. Now the last point, we are going to read this, but we will be understanding this properly in the next slide. A contract that will or may be settled in an entity's own equity instrument. A contract that will be settled in an entity's own equity instrument for which the entity is obliged to deliver a variable number of its own equity instruments. Now let's study this with an example in the next slide. Let's suppose there are 2 entities, entity A and entity B. Entity A buys goods from B. A is buying goods from B with a fair value of $100 million. A is purchasing goods with a fair value of $100 million. And A will issue 10,000 fixed number of shares after 6 months time. A is purchasing the asset right now. For example, A is purchasing this calculator, and this calculator is worth $100 million. And in return, A is going to issue 10,000 shares after 6 months. In this case, the number of shares are fixed. So whenever number of shares are fixed, we are going to treat this as an equity. Whenever the number of shares are fixed, we are going to treat this as an equity. Therefore, the standard says that the asset shall be recorded against a corresponding increase in equity. Asset will be recorded against corresponding increase in equity, and this is a case which is dealt in IFRS 2. This is a share-based payment transaction. This will not fall under IAS 32 or IFRS 9. This is not a financial instrument where the number of shares are fixed. So if A is purchasing goods and issuing shares, fixed number of shares in return, we are going to treat this as an equity. But let's say that the number of shares are not fixed, but the number of shares are variable. A will issue shares equivalent to $100 million. A is going to issue shares that will be equivalent to $100 million. In this case, the number of shares are not fixed, rather the number of shares are variable. So for example, if the share price after 6 months is $10, so the number of shares are going to be 10 million shares. And if the price after 6 months is $5 per share, in that case, the number of shares will be 20 million number of shares. And if the price is, let's suppose, $40, the number of shares are going to be 2.5 million shares. So what will be the number of shares? We don't know right now. The number of shares will vary according to the change in the share price. So in this case, the standard says that this shall be treated as a financial liability. A will record the asset against a corresponding increase in the financial liability. So this will be asset debit and financial liability credit. So what is the difference between both? The difference is that the number of shares are going to be different. In the first case, the number of shares were fixed. So if the number of shares are fixed, the accounting standard IFRS 2 is going to apply, and we are going to treat this as an equity and not as a liability. And when the number of shares are variable, we are going to treat this as a financial liability, and this financial liability is going to be accounted for under IFRS 9. So this is the detail which we have studied in the previous slide in the last bullet. Let's go it through again. A contract that will or may be settled in an entity's own equity instrument. A contract where company is going to settle in its own shares, for which the entity is obliged to deliver. A is going to deliver or going to issue variable number of its own equity instrument. So whenever there are variable number of own equity instrument, it is treated as a financial liability. And when there are fixed number of shares, the transaction is going to be treated as an equity. So if you have any question, you can ask. If you have any question, you can ask them. I think I'm not receiving the question screen. I am unable to see the question screen. Let me check it. No, it's not there. Just give me a second. I will check with the admin to look into it. Why the screen of the question is not visible to me. Just give me a minute. Okay, now I'm able to see the question screen. Let me check it. Okay, Muhammad Asim is asking that please explain the derivative term. I just joined the webinar. Muhammad Asim, we are going to discuss the derivative term later on while we are discussing the hedging. So right now what we have discussed is that whenever there's a derivative which is favorable, we call it a financial asset, and whenever there's a derivative which is unfavorable for us, we treat it as a financial liability. Musa Usman is asking, this is what issuer will record in its books. Yes, yes, Musa, we are studying the entire entries according to the entity A. That's why we have written the entry in the books of A. Iman wants to look at the first screen of the financial asset, and this is the screen, Iman. You can take a snapshot of it. I think people are having some difficulty with respect to joining the WhatsApp group. So I will be trying to share my personal number today so that you can drop me an SMS on WhatsApp and I will add you in the WhatsApp group. So don't worry about it. We will be trying our level best to give you the service. Ravi is asking, can you explain the entity A and entity B concept once more? Okay, Ravi. Okay, now this was a scenario where entity A is purchasing, entity A is buying goods from B, and the goods have a fair value of $100 million. And in return, A may issue shares to B, which may be variable or which may be fixed. If A is issuing variable number of shares, we will call it a financial liability, which will be accounted for under IFRS 9. And if A is issuing fixed number of shares, we are going to call it an equity, which will be treated under IFRS 2. So the accounting treatment depends on the number of shares, whether they are fixed or they are variable. Mohammed Hassan is asking, what about dividend payable? Dividend payable is a financial liability. Okay, Taha Qadri is asking to share the WhatsApp number right now. Taha, please wait for a while. I will be sharing very soon. Okay, now let's have an example where A is going to receive its own shares. Now this is a case where a contract is going to be settled in entity's own equity instrument, but the entity is going to receive its own shares. Receive its own shares. Now again, there are two entities, entity A and entity B. This time entity A is selling goods to B with a fair value of $100 million. In my previous example, A was buying goods. In the current example, A is selling goods to B, and in return, A will receive its own 10,000 shares, and these number of shares are fixed. So A is going to receive its own shares. Now, how can an entity receive its own shares? That is pretty simple. Entity B will go to the stock exchange and buy the shares of A. Entity B will go to the stock exchange and buy the shares of A, and then will provide the shares to the entity A. So this will become a case of a treasury shares. When an entity receives its own shares, that is called treasury shares. So A will receive its own 10,000 shares, and these number of shares are fixed. And whenever A is receiving or issuing fixed number of shares, whenever A is receiving or issuing fixed number of shares, they are going to be treated as an equity. So in this case, the asset will be de-recognized from the books of A, and in return, the equity will be debited, and this equity will be called treasury shares. These equity will be called treasury shares and will be accounted for under IAS 32. So A is going to de-recognize the asset and record the treasury shares by reducing its equity. And if let's suppose A is going to receive its own shares but equivalent to $100 million, which means that the amount is fixed and the number of shares are going to vary. The number of shares are going to vary. So if the number of shares are variable and we are receiving our own number of shares, we will be calling it a financial asset. So in this case, A will de-recognize the asset, credit the asset, and will record a financial asset until A receives its own shares. A will treat it as a financial asset until A receives its own shares. Once the shares have been received, then they are still treasury shares. But right now we are discussing the accounting where A will receive its own shares. A has not yet received its own shares, and this financial asset will be accounted for under IFRS 9. This financial asset will be accounted for under IFRS 9. So in the first case, the number of shares were fixed and we called it an equity instrument, a treasury share. And in the second case, the number of shares were variable. In that case, we are going to call it a financial asset. So whenever there are fixed number of shares, equity, variable number of shares, financial asset. So this is the definition that we had seen uh, in the financial asset definition sheet. Ravi Verma is asking, why is variable payment under IFRS 9? Ravi, not variable payment, variable number of shares, where payment is fixed. If the number of shares are variable, the payment will be fixed. And whenever I have to pay a fixed amount, that is a financial liability. If I have to pay a fixed amount, that is a financial liability. So the concept is pretty simple, that whenever amount is fixed, it is a liability. Whenever number of shares are fixed, the amount is not fixed. So that will be that will not be treated as a financial liability. Rashid is asking, please explain the second example of A and B company. Okay, Rashid, I will repeat. And there's another question, so please explain the concept of treasury shares again. Okay, treasury shares, what are treasury shares? If an entity receives its own shares, those are called treasury shares. If an entity receives its own shares, those are called treasury shares. Simple concept. Ailera is asking, why equity to be fixed in share-based payment equity is always remeasured. Ailera, actually in IFRS 2, the number of shares are always fixed. Even in IFRS 2, the number of shares are always fixed. You will never find variable number of shares in IFRS 2. All variable number of shares are treated as IFRS 9, and all fixed number of shares where I'm issuing is treated under IFRS 2. So there is a very minor difference between IFRS 2 and IFRS 9 in case of issuing shares. Ailera is saying based on number of employees left. Ailera, if number of employees are leaving, they are sort of I would say they are sort of leaving their right. So if the employees are leaving, the number of shares are not varying. The number of shares are fixed per employee. The number of shares are fixed per employee. If we would have made a variable number of shares per employee, that would have come under IAS 32 and IFRS 9. If I say to my employee, work for 3 years, I will give you 10,000 shares per employee. Work for 3 years, I will give you 10,000 shares per employee. So the number of shares are fixed, IFRS 2. If I say to the employee, if you work for 3 years, I will give you shares equivalent to $10,000. If I am paying you shares equivalent to $10,000, that will become a case of financial instrument and not IFRS 2. Let me explain you further that the name of IFRS 2 is share based payment, where the payment is going to be based on the number of shares. But when we fix the amount, when we have a fixed amount, over there the payment is not based on shares, rather the shares are based on payments. If we fix the amount, the payment will not be based on shares, rather the shares will be based on the payment. The number of shares are going to vary depending on the payment. So that will not be a case of IFRS 2. So IFRS 2 is only when the number of shares are fixed and the amount is variable. Okay, Ravi is asking what is the difference between IAS 32 and IFRS 9. Ravi, under IAS 32, we decide what is a financial asset and what is a financial liability. And we don't discuss the accounting of financial instruments in IAS 32. The accounting of financial instruments is under IFRS 9. Identification of financial instrument IAS 32. Accounting of financial instrument IFRS 9. I'm repeating. Identification of financial instrument IAS 32. Accounting of financial instrument IFRS 9. This is the difference. Rao is asking that I can't see any question from other participants here. Yes, Rao. The admin can see the questions from everyone, but I think these rights are not available for the students. Rashid is saying that it is practicable to buy own shares. Rashid, basically, it depends on the country where the company exists. There are certain countries where buying own shares is illegal. There are certain countries where buying own shares is illegal. But there are certain countries which allow buying back of their own shares. But there is obviously a limit up till where the company can buy. But this is something which is not examinable. In the exam, you are expected uh, to, uh, to apply the treatment irrespective of the jurisdiction. Intizar is asking that, sir, is it necessary that the price of shares must be fixed in order to record equity? Intizar, not the price of shares, the number of shares. If the number of shares are fixed, it is equity. If the amount is fixed, it is liability. So we are not talking about the price of share. If the price and the number of share both are fixed, let's say, price is also fixed, number of shares are also fixed, which means that the amount is fixed. Rashid is asking that why companies buy its own shares. Rashid, there are multiple reasons why an entity may buy its own shares, and this is irrespective of this is not linked to the financial reporting or corporate reporting paper. This is an area of financial management. So right now we will not be discussing this. If you want still to discuss this in detail, you can drop me a personal SMS. I will reply you over there. Nabil is asking, sir, good evening. Good evening, Nabil. I just joined 30 minutes late. I've missed a lot. Okay, Nabil, admin will reply you on this. Mohammed Asim is saying that please explain the difference between equity instrument and financial instruments. Okay, Asim, I will be replying to this. Asad Mannan Khan is asking that do we need to remember names and number of standards? Asad, it is preferable to remember the names and the number, but if you don't remember, then you can even just apply the accounting treatment. It is okay. Okay, now let's move forward. We are again short of time, and just to save time, it will be better if you if there's any question that you that is not answered, you can discuss it at the end. Okay, now I'm discussing the summary of what we have discussed right now. Contract settled in entity's own equity instrument, where entity is receiving its own shares, and the shares are fixed, then it will be equity. And if the number of shares are variable, it will be a financial asset. Asset because we are at the receiving side. So we say when the number of shares are fixed, it is equity under IAS 32, and we call this a treasury share. And where the number of shares are variable, we call it a financial asset. And if we are issuing our own shares, if we are at the delivering side of the shares, again the number of shares may be fixed or the number of shares may be variable. If the number of shares are fixed, it is equity under IFRS 2, treated as a share-based payment. And if the number of shares are variable, we call it a financial liability under IFRS 9. So this is the entire summary of what we have just discussed in the previous two slides. Now let's move forward. Now we are going to discuss the puttable instruments. What are puttable instruments? What are puttable instruments? Now let's understand this. That let's suppose this is a company and this is a shareholder. And the company issues shares to the shareholder with an agreement where the shareholder can put back the shares and receive cash at any time. Normally the shareholder cannot come to the company to receive its cash back. But in this case, the question says that the company is issuing shares and giving an option to the shareholder that the shareholder can put back its shares and in return receive its cash. What will happen in this case? We say that the shareholder has the right to put back the shares. This is called a puttable instrument. What is a puttable instrument? Where the holder has the right to put back the instrument and to receive its cash back. Now the question is whether this type of instruments, this type of shares are a financial liability for the company or an equity. This type of shares, whether it is a financial liability or an equity. What is your suggestion? Din is saying liability, Taj is saying equity, PS is saying liability, Intizar is saying liability, Chandan is saying liability, 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 equity, liability, liability, equity, asset. Okay, a lot of people are saying equity and a lot of people are also saying liability. Okay, so in this case, actually, the pen is not working. Yes, it's back. In this case, it is actually a liability. It is a liability. Why? Because the company has an obligation to deliver cash. If the shareholder comes and puts its shares back, the company is liable to provide cash to the shareholder. So we say that this is a case where the company has an obligation to deliver cash, therefore it is a financial liability. So whenever with shares a put option has been attached, a put option is where the holder has the right to put back the shares, it will become a financial liability. This is called a puttable instrument. So I can say that all puttable instruments are a financial liability. All puttable instruments are a financial liability because shareholder has the right to demand cash and the company has the obligation to provide cash. Therefore, we would say that all puttable instruments are treated as a financial liability. And let's say I have changed the scenario. If you people want a snapshot, quickly take it so that I can change the screen. Rao Khan is asking that is put same as redeemable. No, Rao, redeemable shares have a fixed timing at which date the redemption is compulsory. I will discuss this in detail, okay? I will provide you a detailed explanation on this. Okay, now I'm changing the scenario, and now the scenario is that the holder is now a loan note holder and the company has issued loan notes which are redeemable in 5 years. So the loan is to be repaid in 5 years time with an agreement where the holder can put back the loan notes and receive cash at any time before 5 years. Normally in redeemable loan notes, if the redemption is at the end of 5 years, the holder cannot ask for cash before 5 years. But in this case, where we have attached a put option with the loan notes, the holder can demand cash in year 1. The holder can demand cash back in year 2. The holder can demand cash back in year 3, year 4, or year 5. But we cannot move on to year 6. We have to redeem at the end of year 5. And if the holder wants to receive cash before 5 years, the holder has the option. So now in this case, whether it is a liability or equity, liability, 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 liability. Okay, yes, it is a liability because we have to pay the cash either within 5 years or at the end of the 5 years. In either cases, the company has an obligation to deliver cash. So in this case, again, we are going to say that this is a financial liability. So loan notes plus put option is again financial liability. So I am repeating my statement again that all puttable instruments are a financial liability. All puttable instruments are a financial liability because the holder has the right to receive cash, and it creates an obligation on the company to deliver cash. Eiler is asking, what is the difference if there were no option? Eiler, if there was no option, let's suppose the loan notes have no option attached, so that will be a simple liability. And if the equity has no option attached, that will be simply an equity. So if there is no option, the case is pretty simple. So right now we are discussing some complex cases where due to the options, the classification of an instrument may change. Now let's have another case, and now we are going to discuss the callable instruments. What are callable instruments? Let's have an example again. The same company, the same shareholder. This time the company issues shares with an agreement where the company can call back the shares. Where the company can call back the shares. What is the difference? Last time the right was with the shareholder. The shareholder can put back the shares. But now the right is with the company. The company can call back the shares and repay cash at any time. So this time the option is with the company. The company has the right to call back the shares. The company has the right to call back the shares. This time company has the right. So what is a callable instrument? Where the issuer company has the right to call. So now in this case, if the shares are callable, are they an equity or a liability? What do you think? Callable. Chandan is saying equity, Muhammad Bilal equity, Aisha is saying equity, Gwang equity, 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 equity. There is one liability, all other are saying equity. One more liability, asset. Okay, now let me answer. It's good that majority of you people are already answering correct. That this case is a equity. Why? Because the company does not have an obligation to deliver cash. The company will pay the cash if it wants to pay. The word obligation means that someone can enforce the company to pay cash. The word obligation means that someone can enforce the company to pay cash. But in this case, no one can enforce the company. The company will pay the cash if it wants to pay. The discretion is with the company. So we call it as an equity instrument. Okay. Yes, Mohammad Asim, your statement is correct. Sibrat is asking, so equity and liability differ in the obligation. Yes, Sibrat. The difference between liability and equity is the obligation. If I have an obligation to pay cash, liability. No obligation, equity. This is a simple difference. Ravi, I will be answering your question. Let me complete the discussion first, and then I will be answering your question in detail. Okay, now let's have another case, and this time the same company, the same holder, but this time it is a loan note holder, and the company issues loan notes redeemable in 5 years time with an agreement where the company can call back the loan notes. The example is entirely the same. The only difference is that we have removed shares and we have included loan notes. Now the company can call back the loan notes and repay the cash at any time before 5 years. Now what is your suggestion? Is this a liability or equity? Liability, 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 equity. There's one equity as well. Liability, liability, equity, equity. Okay, now let me answer that this is a case of a liability. such loan notes will be treated as a financial liability. Why? Because if the company does not calls back the loan notes, the company still has an obligation to pay at the end of year 5. The company has an obligation to pay at the end of year 5. So there is an obligation on the company, but at the end of 5th year. So we are going to call this as a financial liability, because the company's will is only up to 5 years, and then at the end the company still has to pay the loan back. So we cannot say that all callable instruments are equity. No, this is an incorrect statement. All puttable instruments are a financial liability, but all callable instruments are not equity. Okay, now let me explain you one more point. There were certain questions with this respect. So the discussion that I'm going to do now will make some things more clear. Bintu is asking to move back onto puttable instruments. Bintu, this is puttable instruments. You can take the snapshot. So that this is not the same shares. This time it was the loan notes. So we have discussed actually 4 cases: shares with put option, shares with call option, loan notes with put option, and loan notes with call option. So these are four different things that we have discussed, and then I will also be sharing a summary of all these 4 cases with you. So there is an explanation and there is a summary after that. Okay, now what I have to discuss with you, I'm using this screen over here. Now let's say there are 4 different types of shares. The shares can be redeemed. There are shares which can be redeemed. There are shares which can be called. There are shares which can be redeemed. There are shares which can be called. There are shares which can be put, and there are shares which we can buy back. So these are 4 different statements that you have heard from me in the recent 5 minutes time. That few shares can be redeemed, few shares can be called back, few shares can be put back, and few shares can be bought back. So what is the difference between all these? Let's say if I say about the buyback of shares, if I am the company and you are the shareholder, if I am the company and you are the shareholder, I want to buy back the shares and you don't want to sell. I want to buy back the shares and you don't want to sell. Can the transaction occur? If I want to buy back and you don't want to sell? No, obviously no. People are saying no. Because if you don't want to sell the shares, no one can force you. You don't have an obligation to sell the shares. And vice versa. If you want to sell the shares and I don't want to buy. If you want to sell the shares and I don't want to buy, will the transaction occur? Again, no. So in buyback, the company and the shareholder both should agree. The shareholder should agree to sell and the company should agree to buy. Only in that case the transaction will occur. But if we talk about putting back the shares, if I'm the company and you are the shareholder, I'm the company, you are the shareholder, you have the put option. Is it enforceable on me? You have the put option. If you want your cash back, is it enforceable for me? Yes. So this means that in put option, the shareholder has the option to decide whether the shareholder wants the cash back or not. But in case of calling back the shares, the option is with whom? With the company. So if the company wants to pay back the cash, the company can pay back, but no one can force the company to pay back the shares. And in case of redemption, there is a fixed time at which the company has to pay back the cash and the shareholder or the loan note holder has to put back the loan notes. So in this case, nobody has the option. Nobody has the option. If you want to keep your loan notes, you cannot keep, because at the date of redemption, I'm going to redeem. If I want to extend the time, I cannot do, because the redemption date is the fixed date. At that date, I have to redeem the shares, other than we agree mutually to extend the time period. So these are 4 different types of shares. Now, if I look in which case the company has an obligation, what do you think? In which case, out of 4, in which cases the company has an obligation to deliver cash? In these 4, in which case? Redeemable, put, redeem, 1, put, 1 and 3, 1 and 3, put option, put, redeem, put, 1 and 3, 1 and 4. Okay, now if I look in redemption, the company does not have an option. So if the company does not have an option, the company has an obligation to deliver cash, and we will be treating this as a financial liability. If I look in the call option, in call option, the company will decide whether to pay or not. The company will decide whether to pay or not. Therefore, the company has no obligation. No one can force the company to call back the shares. Therefore, we are going to call this equity. Input, the company has an obligation, the shareholder can enforce. So in this case, we have an obligation to deliver cash. So we would say that this is a financial liability. And in 4th case, again, no one can enforce the company. The company has an option to decide whether to buy or not. So in this case, we will say that there is no obligation on the company. Therefore, this is going to be treated as an equity. So I would say that redeemable shares are a liability. Callable shares are an equity. Puttable shares are a liability, and buyback shares are an equity. So this is how basically the IASB board has decided to classify the instrument as liability or an equity. Guang is asking, can you repeat the redeemable why has an obligation? Guang, because for example, I have issued you loan notes for 5 years, or I have issued you shares which are redeemable in 5 years. I have issued you shares which are redeemable in 5 years. So after 5 years, do I have to pay cash, or is it my discretion? This is a question from Guang. What do you think? If I have issued you shares which are redeemable in 5 years, after 5 years, is it my discretion, or am I compulsory to pay you the cash? Cash, exactly. So if I am required to pay you cash, it is an obligation on me. And when it is an obligation, it is a financial liability. Thank you, Achal and Ravi, for the compliment. So these are the 4 type of shares. Now in the question, if you are given a specific type of share, now you have to decide whether it is an equity or a liability based on the obligation. If there is an obligation, liability. There is no obligation, equity. Okay, now let's move further. This was something that was not planned, but few of your questions enforced me to discuss this area. Okay, now this is a summary of the puttable and callable instruments. In puttable instruments, if it is an equity instrument, which means shares with put option, over here I mean shares plus put option. And in debt instrument, I mean by loan notes plus put option. So if I see that shares plus put option is a financial liability, and loan notes plus put option is also a financial liability, so I can say that all puttable instruments are a financial liability. All puttable instruments are a financial liability. And if we discuss callable instruments, shares plus call option and loan notes plus call option. So in this case, shares plus call option will remain equity and loan notes plus call option will remain liability. So I can say that call option will not change the classification of an instrument. Call option will not change the classification of an instrument. Equity will remain equity and debt will remain debt. Call option cannot change the classification. Equity will remain equity and debt will remain debt. However, puttable instrument will convert all instruments into a debt instrument, into a liability. So this is the summary of the points that we have discussed in the previous slides. So now we are done with IAS 32 till here, where we were deciding whether it is an equity or whether it is a liability. Now we will be moving forward towards IFRS 9, where we are going to discuss the accounting of financial assets and financial liabilities. Mohammad Bilal is saying that puttable options must be expensive. Yes, Mohammad Bilal, when we are giving additional rights to a shareholder, we will charge more. Similarly, in case of a call option, the price will be below the normal price. So puttable instruments are normally expensive and callable instruments are normally more cheaper. All depends on the rights and responsibilities that we are giving to the shareholder. Okay, now we are starting discussing the IFRS 9, and we are starting with an equity instrument. For example, if a company has bought ordinary share capital or preference share capital irredeemable of another entity, this is equity instrument of another entity, which is a financial asset for me. So if I have bought an equity instrument of another entity, which is a financial asset for me, standard allows us to classify such instrument either at fair value through P&L or at fair value through OCI. The standard allows us to classify it either at fair value through P&L or at fair value through OCI. There are two categories allowed for an equity instrument of another entity. Now, on what basis are we going to decide that whether the instrument should be at fair value through P&L or fair value through OCI? So the difference is pretty simple. If the shares are with a short-term intention, then they will be classified at fair value through P&L. And if the intention is long-term, they will be classified at fair value through OCI. So for example, I have bought ordinary shares of a company. What are the possible intentions that I may have? What are the possible intentions that I may have? Retain it, okay. PS is saying that I have an option to retain it, but what is the benefit to retain? Chandan is saying acquire control of the entity, keep it for a long time. Hassan is saying dividend, sell it, price increase, dividend to trade. Exactly. There are three possible intentions behind. Either my intention will be to earn the capital gain, that is to trade, or my intention may be to earn dividend each year, or my intention may be to gain control. I'm writing it again because of some space problem. So either the intention is going to be capital gain, or the intention is going to earn dividend, or the intention is going to be to acquire the voting rights, or to acquire the control, or to acquire the influence. So these are three possible intentions that I may have in acquiring a share. Out of these three, one is a short-term intention and two are the long-term intention. Which is short-term? Capital gain. If my intention is to earn capital on this will be short-term intention, and such shares will be classified at fair value through P&L. And if my intention is to earn dividend or to earn the voting rights, I would say that my intention is long-term, and that will be classified at fair value through OCI. So the classification is going to be based on the intention. The intention will decide the category of the financial asset. Musa is asking, sir, please tell about irredeemable shares. Musa, can you specify what do you mean by tell about irredeemable shares? Mohammed Bilal, thank you so much for the appreciation. Your appreciation actually increases the motivation of the tutor as well. Mohammed Asim is asking, sir, please explain fair value through P&L or OCI. Mohammed Asim, we are going to discuss these categories in detail. Right now, we have just discussed their broad names and in which case the asset will be classified in which category. So we are going to discuss these things in detail as well. So now, for example, a company has bought shares with a capital gain intention. It will be classified in P&L, and if the intention is long term, it will be classified in OCI. Now, for example, I have purchased a debt instrument of another entity. Again, this is a debt instrument of another entity. So for example, if I have purchased a debt instrument of another entity, this time I have three categories. Fair value through P&L, the same as above. Fair value through OCI, the same as above. But this time there is one more category by the name of amortized cost. In this category, amortized cost, an equity instrument of another entity cannot be classified. In the category of amortized cost, equity instrument cannot be classified. Only the debt instruments can be classified. Why so? Chandan is asking why so. Chandan, I will tell you why so when we are discussing the details on the amortized costs as well. So what are some examples of debt instrument? For example, a company has issued loan notes. A company has issued loan notes and another company has bought the loan notes. For example, I am an issuer and you are the purchaser. I am the issuer of loan notes and you are the purchaser of loan notes. For me, the loan notes is a liability, and for you, the loan notes is an asset, financial asset. And this loan notes is a debt instrument because it is a type of a loan. I am raising loan by issuing you the loan notes, and you are giving me loan by purchasing the loan notes. So this was your question, that please give some example of debt instruments. So the best example is loan notes. Okay, now if I am purchasing a debt instrument, when do I have to classify in which category? Now let's see. In amortized cost, an asset will be classified in amortized cost if my intention is to collect the contractual cash flows, which means that my intention is to hold the financial asset till maturity. If my intention is to hold the asset till maturity, in that case the asset will be classified in amortized cost. If my intention is to hold the financial asset till maturity until it is redeemed, in that case I will classify the asset at amortized cost. And if my intention is to collect both the contractual cash flows and selling the financial asset, which means that I will hold the asset for few years and then I am going to sell the debt instrument. My intention is to hold for few years and then sell it. In that case, the asset will be classified in fair value through OCI. So let's suppose there's an asset with a maturity of 5 years. Let's suppose an asset with a maturity of 5 years, and my intention is to sell after 3 years. My intention is to sell after 3 years. In which category do you think it shall be classified? Intention is to sell after 3 years. In which category should be classified? Mohammed Hassan is saying OCI. Akib is saying OCI. Chandan OCI. PS OCI. 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 Exactly OCI. Because my intention is to hold plus to sell. But if my intention is not to sell and to hold for entire 5-year period, in that case I will classify it at amortized cost. Now, one of your questions, that why equity instrument, one of your questions that why, pen is not working. Okay. So one of your questions, that why equity instruments cannot be classified in amortized cost. Now I'm answering your question with a question. Do listen me carefully. Do listen me carefully. Let's suppose I have purchased ordinary shares of a company. Let's suppose I have purchased ordinary shares of a company. And I promise that I'm going to hold these shares until they are redeemed. I have purchased ordinary shares. Ordinary shares are normally irredeemable. And I'm promising you that I'm going to hold these shares until they are redeemed. Till maturity. I'm going to hold till maturity. Tell me in which category should I classify? I have purchased shares which are irredeemable in nature, and I'm promising that I'm going to hold till maturity. Okay, a lot of people are mentioning the right answer, but few are incorrect as well. The answer is pretty simple. Do listen carefully. That the ordinary shares, in actual, they have no maturity. The ordinary shares have no maturity because they are irredeemable. So how can I promise to hold till maturity when they don't have any maturity? If the shares don't have any maturity, how can I promise to hold till maturity? Therefore, this test is by default failed in equity instruments. Basically, this test is called business model test. This is a test which is called business model test. So this test actually fails in case of an equity instrument. By default it fails. This is the reason why we cannot classify equity instruments at amortized cost. Aisha is asking to explain again. Din is also asking to explain again. Okay, I'm explaining it again. Writing it over here in this box. Look, there are shares, and these shares are irredeemable, which means that these shares have no fixed maturity. These shares does not have any fixed maturity. If they do not have any maturity, how can I promise to hold till maturity? In amortized cost, the intention was to hold till maturity. But if they don't have any maturity, how can I promise to hold until maturity? This means that if any instrument does not have a fixed maturity, it cannot be classified at amortized cost. This is why equity instruments cannot be classified at amortized cost. Yes, Neelam, you are right in this case. Uzair, your question is about reclassification. We are going to discuss this in our later slides. Musa is asking, sir, sir, difference between both redeemable and irredeemable preference shares. Yes, Musa, basically there are two types of redeemable preference shares. They may be redeemable. The preference shares may be redeemable and the preference shares may be irredeemable. So if the preference shares are redeemable, they have a fixed maturity. And if the preference shares are irredeemable, they have no fixed maturity. So the redeemable preference shares can pass the business model test, but the irredeemable preference shares cannot pass the business model test because again, they have no fixed maturity. So I can say that in amortized cost, only redeemable instruments can be classified. I can say that at amortized cost, only redeemable instruments can be classified, irredeemable cannot be classified. Okay, there are a lot of questions. Sir, if equity instruments are classified based on our judgment in P&L or OCI, then the standard considers P&L as default category and OCI as a irrevocable choice. Subhash, we are going to discuss all these points, the irrevocable, the default category. We are going to discuss this. But right now, actually, we are having an overview, a bird's eye view of the topic. And then we are going to have the worm's eye view of the topic. We are going to go in detail and understand all of the areas. And then we will come back to bird's eye view by summarizing all of the areas again. So these are some techniques of teaching where we give a bird's eye view, a worm's eye view, and then a bird's eye view. Guang, again, your question is about reclassification. We are going to discuss this. Chandan is saying redeemable is when company will pay the money and shares will be nullified. Yes, Chandan, you are right. Neelam is saying that redeemable preference shares carry debt nature. Yes, Neelam, you are right. Any redeemable instrument is a debt instrument, and any irredeemable instrument is normally an equity instrument. Yes, Hassan. So such shares will be classified in OCI. Mohammed Hassan is saying, so what about debt fair value through P&L? We are going to discuss this, Mohammed Hassan. Okay, now let's move forward. We will be taking a short break as well for namaz, and then we will be coming back. Okay, now let's discuss about fair value through P&L category in debt instruments. Apart from these two, all other debt instruments are classified in fair value through P&L. So you have to decide, is it amortized cost? No. Is it OCI? No, it is P&L. So there is no specific criteria for P&L. It is, we can say, an open category, and any instrument can be classified in P&L without any criteria, without any reason, which we also call a fair value option. Yes, Nadeem, this is the fair value option which I just said, that in fair value option, the instrument can be classified at P&L without any reason. What is a fair value option? That the instrument can be classified in fair value through P&L without any reason. So any instrument can be classified in P&L. Yes, Ailera, you are right. Yes, Muhammad Hassan, you are also right. So we will be taking the namaz break in few minutes, 4 to 5 minutes, and then we will be coming back in after 10 minutes break. No, Muhammad Hassan, there are no conditions for fair value through P&L in debt instrument. Yes, PS, the instrument can be classified in P&L. Okay, now let's move forward. One more point that you have to remember, is that in fair value through OCI and fair value through P&L, there is one more condition, which is that the timing of the cash flows should be fixed. The timing of the cash flows should be fixed. We also call this a cash flow characteristic test. We also call this cash flow characteristic test. So for an instrument to be classified in either of these two, the cash flow characteristic test should also pass. Now we are discussing the accounting of financial assets. Now we are going to discuss the accounting of financial assets for all the three categories on how to account for this. But there's one more point that I'm going to discuss in this, the classification again. We had discussed that in fair value through P&L, the instruments with short-term intention are classified, and in OCI, the instrument with long-term intention are classified. Apart from this, the fair value through P&L is also a default category, which means that if I have purchased an instrument, and I don't know myself whether I'm going to hold till maturity or to sell in between, or I am going to sell within a year, I don't know myself. Whether my intention is to receive dividend, whether my intention is to have the voting rights or to earn the capital gain, I myself am not clear. I'm not clear myself. I haven't decided yet whether I have to keep it or to sell it. In this case, where I have no clear intention, the instrument will be classified in fair value through P&L because this is a default category. So if the condition, if the intention is not clear, we are going to classify in default category. And apart from this, all derivatives other than hedging purpose will be classified in P&L. All derivatives other than hedging purpose will be classified in fair value through P&L. This is a point which we are going to discuss in detail with hedging, because over there we are going to properly understand what is a derivative, what is the use of derivative, what is hedging, what can be the purpose which is other than hedging, and so on. So this is a point which we have to remember right now, and we are going to discuss in detail with the hedging. No, Mohammad Hassan, there are no conditions of fair value through P&L. Mohammad Hassan wants to view the previous slide. This is the previous slide, Mohammad Hassan. Yes, Chandan, default for both equity and debt instruments. Default for both equity and debt instruments. Fair value through P&L is the default category for both equity and debt instruments. The accounting that we are discussing now is for both equity and debt. The accounting for that we are discussing now is for both equity and debt. Okay, now let's discuss the accounting, or we may take a break as well because the accounting will be taking some time. So let's take a break of 10 minutes and offer prayers and come back till 7:27. It's 7:17 right now, and let's come back till 7:27 to continue. Okay, everyone, welcome back. And we were discussing the three categories of a financial asset: fair value through P&L, fair value through OCI, and the amortized cost category. The basis of identifying the category was the intention, whether it's short term or it's long term. Apart from short term and long term, all derivatives other than for hedging purpose will also be classified in fair value through P&L. And plus, this is a default category, which means that any of the financial asset can be classified in this category. Okay, now let's discuss the accounting for all of these. Okay, Akib, your request is noted, and we will try this. Chandan is asking to repeat the cash flow characteristic test. The cash flow characteristic test is pretty simple. Cash flow characteristic test passes when the amount and the timing of cash flows are fixed. Amount and timing of the cash flows are fixed. If amount and timings both are fixed, cash flow characteristic test is passed. If any of these is not fixed, the cash flow characteristic test will fail. So we were discussing about the accounting. What is the accounting of both the categories? So I'm starting from the measurement. In both the categories, the financial assets are measured at fair value at each year end. So irrespective of OCI or P&L, they are going to be carried at fair value. But in this case, in the first case, the fair value movement is taken to P&L. And in OCI, in fair value through OCI, the fair value changes are taken to OCI. Now, why is there a difference between the P&L and OCI? Why P&L and why OCI? The reason is pretty simple. Let's have an example. For example, you have bought some shares of a company. You have bought some shares of a company with an intention to have the voting rights. You have purchased the shares with an intention to have the voting rights. And let's suppose few days later, a friend of yours calls and says, hey, you says what? Your friend says that the shares that you have bought, their prices have reduced to half. The shares that you have bought, the price, the market value of those shares has reduced to half. What will you say? I think you will say, I don't care, because my intention was never to earn cash. My intention was to have the voting rights. The price fluctuation will not affect your voting rights. The price fluctuation will not affect your dividend. So whenever our intention is long term, the price fluctuation will not create a gain or a loss to us, because our intention was never to earn cash. Therefore, we record such movement in OCI, because that is not a gain or loss to me. But if my intention was short term, if my intention was to gain cash, was to earn cash, was to earn the capital gain, was to earn the increase in the share price, in that case, the share price fluctuation is a gain or loss to me. So when my intention is short term, fair value changes taken to P&L, and when my intention is long term, the fair value changes are taken to OCI. This is the major difference between both the categories. And this is why there are two different categories, because in one, we are at a loss because of the fair value fluctuation, and in the other, we don't care. It doesn't matter to us whether the price is increasing or decreasing. But if we look at this, that interest, dividend, gain or loss on disposal is taken to P&L in both the cases. Why is this so? Because any gain or loss which is already in terms of cash, interest is cash, interest received is cash received, dividend received is cash received, gain or loss on disposal is cash item. So any gain or loss which is in cash cannot be recorded in OCI. In OCI, only those values can be recorded which are non-cash. So therefore, in both the categories, the interest, the dividend, and the gain or loss on disposal have the same treatment. Both of them are recognized in P&L. So both are carried at fair value. Interest, dividend, gain or loss on disposal, both of them are goes to P&L, and the fair value changes are different because of the intention. In one case, in fair value through P&L, the fair value fluctuation is a gain or loss. But in OCI, I don't care. I don't care whether the price is increasing or decreasing because my intention is not to sell them. Now, if we look at the transaction cost of both of them, in fair value through P&L, the transaction cost is expensed out, recorded in P&L. And in fair value through OCI, the transaction cost is capitalized. In fair value through P&L, transaction cost is expensed. In fair value through OCI, the transaction cost is capitalized. Why is this so? Why is the difference? The difference is pretty simple. That if my intention is long term, the transaction cost is not an expense of a specific year. It relates to multiple years. Then why should I record an expense in current year? In long-term intention, the transaction cost will provide me benefit for multiple years. Then why to expense in the current year? But in fair value through P&L, the intention is already short-term. So there is no need to capitalize the transaction cost. Therefore, we initially record this at the fair value, at the market value of the shares purchased. But in case of fair value through OCI, we record it at fair value plus the transaction cost, which will give us the total cost of the investment. So therefore, in fair value through P&L, we record initially at fair value, and in fair value through OCI, we record at the total cost, which is fair value plus the transaction cost. So this is the accounting treatment of both the categories. PS is asking an example of transaction cost. PS, for example, I'm purchasing shares. So I cannot purchase the shares directly. I need to go through a broker. So the brokerage cost is a transaction cost because I cannot purchase the shares without a broker, and the broker will charge me an amount. So the brokerage cost is a transaction cost. So this is one of the best examples of transaction cost. There may be some other type of cost as well. For example, if you have taken a legal advice to purchase the shares. For example, if you are paying cash to convert the shares or the loan notes on your name, that will create an additional cost. So any cost that is necessary to bring the asset onto your name or to enter into the transaction is a transaction cost. Lim is asking when we minus transaction cost or plus transaction cost. Lim, your question will be more relevant when we are discussing the amortized cost category. I will answer your question over there. Eiler is asking what will not be transaction cost. Eiler, any cost that is not a direct cost is not a transaction cost. So by transaction cost we mean any direct cost incurred on those financial assets. So this is the accounting of both the areas. Normally the accounting for fair value through P&L and OCI are discussed, are asked, are examined in the consolidation question of the past papers. So these two categories are more relevant for section A, and amortized cost is relevant for both section A as well and section B as well. Now let's move on to amortized cost category. Now we are discussing the accounting for amortized cost category, where we have purchased a loan notes, which is a financial asset for us. This is the amortized cost category where we have purchased the loan notes, and those loan notes are a financial asset for us. Now the question says that we have purchased 6% loan notes with a par value of $100 million. Are you people able to hear me now? Okay. Okay, that's good. Thank you. I'm switching on the video as well. Okay, now let's continue. Okay. So now what we were discussing is that we have purchased the loan notes. We have purchased the loan notes. Therefore, these loan notes are a financial asset for us. There's a 6% interest on these loan notes and the par value is $100 million. The discount is $12 million and the premium is $3.92 million. Premium is the amount that I'm going to receive in addition to the par value at the redemption. Premium is the value that I'm going to receive in addition to the par value at the time of redemption. And discount is the amount that I have paid less than the par value. Discount is the amount that I've paid less than the par value. Premium that I will receive more than the par value. And the transaction cost is 2 million. The cost to enter into the transaction is 2 million. Maturity is 4 years, which means that the loan notes will be redeemed after 4 years. The market rate is 11% and the effective rate is 10%. Now let's first understand that what is the difference between the market rate and the effective rate. What is the difference between the market rate and the effective rate? If we look, the interest that we are going to receive is 6%. Apart from this 6%, we are also receiving a discount. Plus, we are also receiving a premium. So all these adding up will effectively make the market rate, which is 11%. So interest is an income for me, discount is an income for me, premium is an income for me. All of them will combine together to make the market rate, because I am not going to agree at a rate below the market rate. I am the purchaser, I am the receiver. I will not agree at receiving a rate below the market rate. And you, if you are the issuer, you will not agree to provide me a rate higher than the market rate. You will not provide me higher than the market rate. I will not agree at lower at the market rate. Therefore, all transactions are being settled at the market rate. But to gain this market rate, I have paid a transaction cost as well. To gain this market rate, I have paid a transaction cost as well. Just give me a minute. Okay. Thank you. Okay, yes. Now the pen is working properly. So to gain this market rate, I have paid a transaction cost. Now this transaction cost will reduce my income. This transaction cost will reduce my income, making it effectively an effective rate. So what is the difference between a market rate and effective rate? The difference is the transaction cost. The ultimate income that I'm going to earn is 10%, but the amount that you are paying me is 11%. You are paying me 11 minus a transaction cost, resulting that the amount going in my pocket is 10%. So this is a complete understanding of the question. Now, how are we going to answer this? Now let's discuss the accounting. In fact, it's better to write it over here. I'm writing the double entries below this line. In year zero, when I have purchased the financial asset, I'm going to record the transaction as financial asset debit and bank credit. By which amount? By the par value of 100 minus discount of 12. The par value was 100 and I've got a discount of 12. So the difference will become $88 million. This is the amount that I've paid to purchase the financial asset. So my entry is going to be financial asset debit by 88 and bank credit by 88 in year zero. Plus, in the same year, I have also paid the transaction cost, which is of 2 million. So bank credit by 2 million. And what should I debit? Should I capitalize this transaction cost or should I expense it out? What is the suggestion? Chandan is saying to capitalize. Walid is saying to capitalize. I want more answers. Sayyid Muhammad Irfan is saying expense out. Capitalize, expense, spread, capitalize, 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 capitalize. It's long term, then capitalize, 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 otherwise expense out. Okay, so majority answers are completely correct. Capitalize because the asset is classified at amortized cost, and amortized cost is a long-term intention category where we are promising to hold the asset until maturity. So if the intention is long-term, this means that the transaction cost should be capitalized. So in year zero, which we can say is the brought down of year one, the financial asset will be of 90 million, 88 plus 2 million. So the financial asset will be recorded initially at 90 million. And the interest income will be calculated at the effective rate, which is 10% and which will apply on the brought down balance. So the interest income of year one is 9 and the amount of interest received is going to be 6% of the par value. 6% of the par value, which will be 6 million, which means that the amortization will be of 3. 9 minus 6. Amortization is 3 and the carried down will become 93, which is 90 plus 3. What does this complete calculation mean? The brought down was 90. As an investor, I have invested 90 and effectively my income is going to be 10%. So my income is 9. But I haven't received 9. I have received only 6. So what will happen of the remaining 3? Remaining 3 is a type of a receivable for me because I'm going to receive this 3 million at the time of redemption in the form of a premium. I'm repeating my statement. My investment was 90. My income is 9. But I receive only 6. What about the remaining 3? So we say that remaining 3 is a type of a receivable. It is a financial asset and the financial asset of 90 will increase by 3 so that my receivable becomes now 93. This will increase every year and will ultimately be equivalent to the par value plus the premium because that is the amount that I will receive ultimately. So in year 2, the brought down will be 93 and 10% is going to be 9.3. And again, I'm going to receive 3. The amortization will now be 3.3 and the carried down is going to be 96.3. Similarly, in year 3, 96.3 will be the brought down. 9.63 is going to be the interest income. Interest received will be 6. 3.63 is the amortization. And 99.93 will be the carried down for year 3. And year 4 is the last year where 99.93 is the brought down. 9.99 is going to be the interest income. 6 we have received and 3.93 is the amortization. And 103. Let me check. 103.86 is the answer. So this will automatically become the amount which is par value plus the premium. There will be some rounding of difference obviously, but this will automatically be the amount which is par value plus the premium, which we already knew that we are going to receive at the date of maturity. So this is how the table of the entire 4-year period will be made. And what will be the accounting entries? In year 1, we are going to record the interest income by 9 million. However, we have received the interest of 6, which means that the financial asset shall be increased further by 3. Income is of 9, we received 6, so the receivable, the financial asset will be increased by 3. Similarly, in year 2, the interest income is going to be 9.3. The amount received by us in year 2 is going to be 6, and the financial asset will be increased by 3.3, and similar entries will be made in year 3 and year 4 as well. Muhammad Irtiza is asking how you got the 6% interest calculation. Muhammad Irtiza, the treatment is pretty simple. The interest that we will be receiving will be of 6%. 6% of what? 6% of 100 million. So interest received is always the coupon rate, which is 6 into the par value, which is 100. Ayla is asking why we don't discount brought forward asset as for leasing. Ayla, because these values are already discounted values. For example, if you calculate the present value of all future cash flows, it will automatically become 90. You can try it at your own. Rohit is asking, will the answer be same in case of calculation by unwinding? Yes, Rohit, this is the same. We are actually unwinding. 90 million, 10% is unwinding. So we can also say it that way. Okay, Chandan is asking that is there any significance of sum of all the amortization over the entire life? Yes, Chandan, we can say that. So please show how the entries for settlement on maturity. Okay. Saad Rafiz is asking why we added the transaction cost 2 million. Will you please repeat? Okay, now let's discuss another thing that will answer a few of your questions. Let's try to add the amount of amortization. Let's try to add the amount of amortization. I want answer from your side. The sum is 13.86. Okay, Chandan has already calculated this. The sum is 13.86. Now if we see, apart from interest, we were receiving a discount of how much? Of 12 million. We were receiving a premium of 3.86, and we have paid a transaction cost of 2. If we look at all three values, this will sum up to be 13.86. So actually what we have done is that we have spread these three values over 4-year period. The transaction cost was not an expense of any specific year. It relates to all 4 years. The discount is not an income of year 0 only. It is of 4 years. The premium is not an income of the last year. It relates to all 4 years. So we have added all three and we have spread them over the life of the asset, life of the financial asset. So this is why we have amortized, and this is why we have capitalized the transaction cost. The reason to capitalize the transaction cost is basically to amortize, to spread these three values. Okay. Jamila is highlighting some rounding of difference. Jamila, I think that does not care as much. Because there will be a rounding of difference always. The premium was 3.92. People are saying that the premium is 3.92 and the amortization is actually 3.99. So this will give us the exact value of 103.92. So this will also be 13.92 and this will be 13.92. Okay, thank you for highlighting the problem. Okay, Rao Khan, we have corrected it. So now the premium is 3.92. So this is how we are going to calculate the entire table and the entries. Now, for example, if we discuss the last year entry of year 4, what will be the entry of year 4? In year 4, first we are going to record the normal entry of interest income, bank and financial asset. Interest income by 9.99, bank by 6, financial asset by 3.99. Now this will bring the financial asset to, sorry. Now this will bring the financial asset to 103.92, and when we redeem it, when we are going to receive the cash, we are going to prepare an entry of 103.92 bank debit and financial asset credit. So this is the entry which will be recorded in the last year. Thank you, Vada, for the compliment. Mohammed Hassan is saying here what brought down is calculated after subtracting nominal amount into effective rate. No, Mohammed Hassan, year 1 brought down is simple. The amount that we paid for the financial asset and the transaction cost, we have simply added both of these. 88 plus 2. This is the simple procedure of calculating the brought down. Okay, now let's move forward. Now we are discussing the amortized cost category of a financial liability. Because the accounting is more or less the same, there is very minor difference in between. So therefore, we are going to discuss the amortized cost category of both together. So now this time we have issued the loan notes with a par value of 100 million, coupon rate of 5. This time we have given the discount of 7. We are giving the discount of, we are giving the premium of 3.24 and we are giving the transaction cost of 3. This time all these values are a outflow for us. So in this case, I will say that the interest is an outflow plus discount is an outflow plus premium is an outflow, which will give us the market rate. And this time the transaction cost is also an outflow. So this time the transaction cost will be added in the market rate to calculate the effective rate. This time the transaction cost will be added in the market rate to calculate the effective rate. So there was a question previously, someone was asking when to add transaction cost and when to less transaction cost. So the treatment is simple: add the transaction cost when it is a financial asset and less subtract the transaction cost when it is a financial liability. So this has a maturity of 3%, market rate of 9% and effective rate of 10%. Now moving on to the next slide to record the double entry of year 0. In year 0, we are receiving the cash this time, so the entry will be bank debit and financial liability credit. The par value was 100 minus the discount was of 7. So the amount that we have received is $93 million, for which we are going to record the transaction as bank debit and financial liability credit. In year 0 again, we have paid the transaction cost as well, which was of 3 million. So this 3 million we have paid, so the bank will be credited by 3. And again, should we expense the transaction cost or should we capitalize it in the financial liability? What is your suggestion? Should we expense the transaction cost or shall we capitalize it in the financial liability? Capitalize, capitalize, expense, capitalize. Yes, actually we are not going to record it as an expense because this is an expense for the 3-year maturity. This is the expense for entire 3 years. This is not an expense for year 1 only. So what we are going to do is we are going to capitalize it in the financial liability by debiting it. And then this transaction cost will be amortized over 3 years to be recorded in P&L. We will see again. So in year 1, this time the brought down is going to be 90 again, 93 minus 3. The interest expense is going to be calculated using the effective rate again, which will be applicable on the brought down balance, resulting in an interest expense of 9 million in the year 1. And the interest paid is going to be par value of 100 into coupon rate of 5. So the interest paid will become 5. The difference of interest expense and interest paid is 4. This means that our expense was 9, but we have only paid $5 million. So what about the remaining 4? When we are going to pay that? We will be paying that at the time of maturity in the form of a premium. So 90 plus 4 will become 94. In year 2, the brought down will be 94 and the expense will be 9.4. Payment is 5, amortization is 4.4, and the carried down is going to be 98.4. In year 3, which is the last year, the brought down is 98.4. Interest expense is 9.84. Interest paid is 5, 4.84, and this time it will be 103.24. Again, this value will be the same as the par value plus the premium. So the entire accounting is the same for the financial asset and the financial liability, other than the only difference that we have felt up to now is that the transaction cost increased the financial asset and has decreased the financial liability. This is the only difference. The entire remaining treatment is the same. The transaction cost had increased the financial asset and has decreased the financial liability, and the remaining entire treatment is the same. The only minor difference further that I would say is that we have said interest expense instead of interest income and interest paid instead of interest received. So the entries for year 1 is going to be finance cost debit by 9. The interest paid is of 5 and the financial liability will be increased by 4. This is the entry for year 1. And if we also make the entry for year 2, we will say the finance cost is 9.4. The amount paid is 5 and the financial liability has increased by 4.4. So these are the entries for year 1 and year 2. Nabil is asking to repeat the transaction cost point. The transaction cost increases the financial asset and the transaction cost decreases the financial liability. This is the point that I had mentioned. Muhammad Hassan Rana is asking that transaction cost will be added in when financial asset and subtracted when financial liability. Yes, Muhammad Rana, you are right. So the transaction cost will increase the financial asset and will reduce the financial liability. So this was the complete accounting of amortized cost of financial asset and financial liability. We are also short of time. There are a lot of areas that we still have to discuss. Okay, now let's move on to the next slide. Tawqir is giving a suggestion to write on the screen. Okay. Tawqir, in case of a financial asset, transaction cost increases the financial asset and the entry is financial asset debit and bank credit. And in case of a financial liability, the transaction cost reduces the financial liability and the entry is financial liability debit and bank credit. So you can take the snapshot now. Okay, now let's move further. Chandan is asking for the logic behind this. Chandan, I think we are already short of time, so the examiner will not be asking the logic. So for the time being, I'm skipping your question just to save time, and maybe I will be answering your question sometime later. Okay, now this is the example 3, and again we are discussing the amortized cost, but this time we have issued a convertible loan notes. Convertible loan notes is a compound financial instrument. What is a compound financial instrument? A compound financial instrument is an instrument which has both an equity instrument and a debt instrument. Compound financial instrument is an instrument which has both a debt instrument and an equity instrument. So what we need is we will be needing to break them. We will be needing to create a difference between debt and equity. And how we are going to calculate that? The debt will be the present value of all cash flows discounted at the market rate. Debt, the value of debt we are going to calculate as the present value of all cash flows discounted at the market rate. And we are going to calculate equity as the balancing figure. We are going to calculate the equity as the balancing figure. Now, let's read the question. We have a 6% convertible loan note with a par value of 100. We are the issuer, which means that this is a financial liability for us. We have given a discount of 4 million. We will be giving a premium of 3 million, and we have paid a transaction cost of 1 million. The maturity is 3 years, market rate is 9%, and effective rate is 9.38%. And these are convertible into 25 million shares at the end of year 3. If the loan note holder would want shares, we will be providing 25 million shares. Now let's record the entry for year 0. In the entry for year 0, we are going to record bank debit by par value of 100 minus the discount of 4, which will give us a total of 96. And we will be crediting both financial liability and equity. Both will be credited. But by which amount? For this, we need to perform a calculation on the next slide. We are going to calculate the present value of all cash flows discounted at the market rate. So the discount factor we are going to use is the 9%, which is the market rate in the previous slide. We are going to use the discount rate as the market rate, 9%. So for 3 years, we are going to pay an interest of 100 into 6%, which will give us an interest of 6 million. So I'm writing over here year 1 to 3, we are paying an interest of 6. And at the end of year 3, we are going to redeem with the premium. So the redemption will be 100 plus a premium of 3. So this will become 103. Cash flow is 6%, cash flow is 6 million annually, and redemption of year 3 is 103. So can you calculate the present value at 9%? Please inform me the final answer. Akib Yusuf is asking what will happen if the compound financial instrument is purchased. Akib, if we have purchased the compound financial instrument, it is a financial asset. And again, we have 3 categories, the fair value through P&L, the OCI, and the amortized cost, and the treatment is pretty simple and same as well. Answer is asking that, sir, could you please do this calculation as one example since I never get my answer right for this part. Okay, Anshul, I can do this for you. For the first 3 years, we are going to calculate the annuity factor as 1 minus 1.09 to the power minus 3 divided by 0.09. So this will give us the annuity factor of 3 years. Can anybody tell me the value? The value of the annuity factor? 2.531. Thank you, Walid. The answer is 2.531. Thank you, PS. 2.531. And can you please also inform me the discount factor for year 3? The formula for discount factor is 1.09 to the power minus 3. 0.772. Thank you, Mohammed Hassan, Walid. So this is 0.772. Now we are going to multiply 6 by 2.531, which is 15.19. I'm calculating to 2 decimal place, and 103 into 0.772 will be 79.52. And if we add both of them, so this will be 79.52 plus 15.19. This will make 94.71. So I've calculated up to 2 decimal places. Taj Muhammad is asking, sir, won't we add interest of 6 at year 3? Taj, we can do it that way as well. In that case, we will be using 1, 2, 2 and 3. And then here it will be 6 and then 109. And this will also give you the exact same answer. So both of them is correct. Okay, now 94.71 is the financial liability that we are going to write over here. It was 94.71. And if we check the difference between 96 and 94.71, so we will get the equity of 1.29. So this is how we are going to initially record the compound financial instrument in both equity and liability. Yes, Bintu, if there is no premium in the question, we are going to use the par value of 100 at the end of year 3. Okay, now we have to deal with the transaction cost. How we are going to record the transaction cost is that we will be crediting bank by 1 million. And again, we are going to divide the transaction cost in both the liability and the equity. We are going to divide the transaction cost in both the liability and equity. But how? What percentage in liability and what percentage in equity? This is simple. If we look at the first entry, the liability was 94.71 out of 96. So if we check the percentage of financial liability, it will be 94.71 out of 96. The compound financial instrument is of 96 and the liability is of 97.41. So we can say that 98.6% of the compound financial instrument is a liability. 98.6% of the compound financial instrument is a liability. So the transaction cost allocated will also be 98.6% of 1, which will give us 0.99, rounded off to 2 decimal places. So 0.99 is the transaction cost allocated to the financial liability. And if we look at the percentage of equity, so the percentage of equity will be the remaining 1.4%. So 1.4% of the transaction cost will be allocated to equity, which rounded off to 1 decimal place will give us 0.01. So this is how we are going to allocate the transaction cost in both liability and equity. Okay, everyone, welcome back again. So can you people hear me now properly? Okay, that's good. So let's resume the session. We were discussing about the amortization table, and the brought down was 93.72. The brought down was 93.72 and 9.38% was 8.79. The interest paid was 6. The amortization is 2.479. And if I add 93.72 plus 2.79, this will give me 96.51. So this is the carried down for the first year. And year 2, the brought down is going to be 96.51 and 9.38%. Also, this is going to be 9.05. So this is the interest expense of year 2, 3.05 is the amortization, and 99.56 is going to be the carried down for year 2. And year 3, 99.56 into 9.38% is going to give us 9.34. After deducting 6, the difference is 3.34. So we will be adding 3.34 plus 99.56, which is going to give us 102.9, which is approximately 103, which was the par value plus the premium. So this is how, in case of a compound financial instrument, we are going to record the liability. Taj Muhammad is asking that from where did we get this 93.72? Okay, let me repeat this. In my previous slide, we had recorded the financial liability at 94.71, and then we deducted the transaction cost of 0.99 from this. So the liability after deducting the transaction cost was 93.72, and this is being used further in the table. So 93. No, Tariq. It is 94.71 to 93.72. Hassan, we are going to discuss the entry for year 4. Rashid is asking, why is the criteria to use market or effective rate of interest? Okay. Ali Minas is asking, do we always discount our cash flows at the market rate and calculate the interest expense using the effective rate? Yes, exactly. This is how we do it. That whenever we are calculating the present value, we will be using the market rate. Whenever we are calculating the present values, we will be using the market rate. Why? This is the question, why? And why we use the effective rate when we are calculating the table, the interest expense? The answer is pretty simple. Do focus on it. What was the difference between the market rate and an effective rate? If we adjust the transaction cost with the market rate, we will be getting the effective rate. That's so? So when we were calculating the present values, have we included the transaction cost in this? Have we included the transaction cost in the cash flows? No. Therefore, the transaction cost should not be there in the rate as well. If the transaction cost is not there in the cash flows, it should not be there in the rate as well. Therefore, we have used the market rate. But when we use the brought down balance, this value is after the transaction cost, which means that transaction cost is included in the brought down. Therefore, the transaction cost should also be included in the effective rate, in the rate. This is why we are using effective rate in the table and the market rate in the present values. So everything has a logic behind, and that is a very deep logic, but the examiner is not going to ask you the logics. From exam perspective, we say that this is how it is going to be done. And apart from all, in the webinar, we also have short time to cover every area, so it is not possible to discuss every single logic, but I try to discuss as much as I can. Okay, now we are summarizing all of the points of the compound financial instrument. Now, what is a compound financial instrument? Compound financial instrument is an instrument which has both an equity component and a debt component. What is the accounting procedure? We record the bank as par value minus discount. We record the financial liability as the present value of all cash flows discounted at the market rate, and we calculate the equity as the balancing figure. We have discussed all these points. I am just summarizing the bird's eye view. Now further, what we have to do is that for the transaction cost, we credit the bank by the amount of the transaction cost, and we debit both the liability and the equity by which amount? In the same proportion as the above entry. Which above entry? This above entry. So the transaction cost is to be allocated in both the liability and equity in their proportion. So this is the complete summary of compound financial instrument. If you take a snapshot and you memorize these points, you will be easily able to cover them in the exam. Mohammed Siddiq is saying that actually it's a jet plane eye view. Okay, Rao Khan is saying what will we do if compound financial instrument is an asset investment? Will we be posting liability as asset and keep all the same working? Yes, Rao Khan, we will. The entire procedure will be the same. The liability, the financial liability will become financial asset as it will be a right to receive cash, and the equity will also become a financial asset because it is an equity instrument of another entity. So both of them will become a financial asset for us, and then we will be proceeding that way. Okay. So there's a note as well that interest rate to calculate interest expense will be the effective rate. The interest expense, while calculating the interest expense, the rate will be the effective rate. Okay, one point we have skipped in the previous slide. I'm moving back again to discuss that. That this was the complete calculation for the 3 years. Now, the loan note holder may either demand cash at the end of 3 years, or the loan note holder may demand shares after the 3 years. The loan note holder has both the options. Now, what will be the entry if the shareholder, if the loan note holder demands shares? In that case, what will be the entry? If the loan note holder demands shares, we are going to provide shares, and the share capital, share premium will be credited. And as we issue shares, the obligation to deliver cash of 103 will be eliminated. We are no more liable to pay any amount. Plus, the equity that we had recorded earlier, by which amount? Moving back further, the equity of 1.28. This was basically an equity option. This was basically a conversion option. This was basically a share option. So now the share option has been exercised. And once the option has been exercised, we will de-recognize it. So in this entry, we are going to remove the share option as well. Let me recheck the amount. It was 1.28. So liability debit by 103, equity debit by 1.28, and the number of shares that we were giving were 25 million mentioned in the question. So the premium will be the balancing figure in this case. 103 plus 1.28 minus 25 is 79.28 is going to be the premium. So this is how we are going to record the entry if the loan note holder demands for shares. Yes, Mohammad Asim, you're right. In case of consolidation. But if, for example, the loan note holder demands for cash, what will be the entry in that case? In that case, we will be paying 103 million to the loan note holder, and the entry will be bank debit financial liability, sorry, bank credit financial liability debit. Plus, what will we do with the equity option in this case is that if we have paid the cash to the loan note holder, this means that the equity option has lapsed. The equity option has lapsed. Now the loan note holder cannot demand for the shares. So the option has expired. So we will be removing the option and debiting by 1.28, and we will be crediting retained earnings by 1.28. So the amount that is being recorded, the amount that is recorded in the equity option will be converted to retained earnings. So this is how we have to deal if the loan note holder demands for shares or demands for cash. Hassan and Mohammed Asim are asking to please repeat the last entry. Okay, the last entry is that if the loan note holder has asked for cash, we have paid the cash. We have paid the cash, bank credit, no more liability. But in this case, when the loan note holder has received cash, do the loan note holder still has the equity option? Does the loan note holder still has the equity option? Hassan Abbas and Muhammad Asim, the question is to you. If we have paid the cash, have both of them still the share option, the conversion option? No. This means that the equity option will be eliminated by debiting it. And where we will take it? We will take it to the retained earnings. So this is the last entry that you people were asking. Rashid Hanif is asking, but why it go to retained earning? Basically, Rashid, all the equity instruments, any gain or loss on those equity instruments will remain within equity. Any gain or loss on the equity instruments will remain within equity. They are not taken to P&L. This is why we are taking to the retained earnings. Hassan Abbas is saying I was asking about equity option first entry. Okay. In the first entry, the loan note holder has demanded for shares and we have paid the shares. So once we pay the shares, share capital and share premium will be credited. And once we have given the shares, we are no more liable to pay any amount. So this will eliminate the financial liability from us. So financial liability will be debited. And as they have exercised their conversion option, their equity option, their share option, it will also be eliminated. So this is how we have created the first entry. Rashida is asking 25 million as shares or amount. 25 amount. So in this case, this is 25 million shares into $1 par value, which is Tahir is asking, Assalamu alaikum, can you please tell me if I have the download option as I am not available in prescribed timing? Yes, Tahir, you have the download option. You can download the lecture from the Vimeo channel of ACCA. The admin will guide you on this, and if you are unable to get any response, you can ask the admin on email. They will be probably replying to you. Okay. Okay. So people are saying to move forward because a lot of areas are being left. Okay, can you people hear me now again?
Yes.
Okay, we are sharing the WhatsApp link as well with you people so that if in case of any technological problems, you people are able to contact with us over there as well. And I will be sharing my number as well so that you people can also contact. I'm writing my number on the screen. Okay, so this is my contact number +92 334 3739 697. You people can message me on this if you are unable to join the webinar group, and please don't try to call without asking because a lot of people start calling without looking at the time or the other commitments of the trainer. So you can drop me an SMS. I will reply you according to my time availability. Okay, so you people have taken the snapshot. I'm removing my number now. Okay, now let's continue. We are discussing the topic of reclassification of financial assets now. We had total three categories: fair value through P&L, fair value through OCI, and the amortized cost category. In fair value through P&L, an equity instrument of another entity can be classified. A debt instrument of another entity can also be classified. In OCI, again, equity can also be classified, debt can also be classified. But in amortized cost category, only the debt instrument can be classified. Now, the first rule, that assets at fair value through OCI cannot be reclassified. Once an asset has been classified in OCI category, it cannot be reclassified. Which means that the reclassification possible are only of two types: from P&L to amortized cost, and from amortized cost to P&L. And as an equity instrument cannot be classified at amortized cost, we can say that equity instrument of another entity cannot be reclassified. Because if it is in P&L, it cannot go to amortized cost. If it is in OCI, it cannot be reclassified. So we can say that equity instrument can only be classified once, and then there is no reclassification of equity instruments of another entity. Or we can only say that only debt instruments of another entity can be reclassified. All these 3 points are actually covering the same. All these 3 points are actually covering the same point. Din is asking why we have to reclassify. Then maybe there is a change in the intention. Initially our intention was short term, but then our intention changed to long term. Or initially our intention was long term, and then our intention changed to short term. So because of the change of intention, there is a possibility of reclassification, but the reclassification is not allowed in fair value through OCI and is only allowed from P&L to amortized cost, or from amortized cost to P&L. Now let's say that we are reclassifying an asset from amortized cost to P&L. We are reclassifying an asset from amortized cost to P&L. So what we will do is, let's suppose we are reclassifying the asset at the end of year 2. We are reclassifying the asset at the end of year 2, which means that an asset was being amortized. This is the example 1. The example 1 which we have already discussed in the previous slides. This is again, we are referring to the answer of the example 1. This is the table is the same as of the example 1.
So let's suppose that at the end of year 2, we are reclassifying the asset from amortized cost to fair value through P&L, and the fair value on this date is 98. This is the fair value on this date is 98. So what we have to do is that we will remeasure the financial asset to its fair value, which means that we will increase the financial asset from 96.3 to 98 with gains and losses taken to P&L, with any gain or loss taken to P&L. So this is a simple rule of reclassification of how you have to reclassify. Subhash is asking that debt financial asset either classified as fair value through OCI can't be reclassified in another category. Yes, Subhash, fair value through OCI is a closed category. You cannot reclassify from there. Whether it's equity or it's debt, you cannot reclassify. Hassan Khan is asking, we can reclassify to fair value through OCI but cannot from fair value through OCI, right? No, Hassan. Let me move back. The fair value through OCI is a closed category. Neither we can reclassify to OCI nor we can reclassify from OCI. Both are restricted. We cannot go from P&L to OCI. We cannot come from OCI to P&L. We cannot go from OCI to amortized cost. We cannot come from amortized cost to OCI. All these movements are restricted, are prohibited. So only from P&L to amortized cost or from amortized cost to P&L. Only two types of reclassification are allowed. So now if we are moving from amortized cost to P&L, what we will do, we will be remeasuring the financial asset to its fair value. That is from 96.3 to 98 with the gain or loss taken to P&L. But if we are moving from fair value through P&L to amortized cost, if we are moving from fair value through P&L to amortized cost, which means that we are already at 98 and now we want to move to the amortized cost category, what will we do in this case? The standard says that the last fair value will be deemed to be the amortized cost. This means that you should not go from 98 to 96.3. No. You cannot go from 98 to 96.3. No. You will remain at 98, and what you do is that make a brought down balance of 98 in year 3 and start amortizing 98 from now in such a manner that this 98 amortizes to 103.92. The standard says that amortize 98 in such a manner that it moves to 103.92 by the end of year 4. So we have to amortize in such a manner that the 98 million moves to 103.92. For this, there is one more problem. For this amortization, we cannot use the normal effective rate, which was 10% in this question. Because 10% would amortize 96.3, it would not amortize 98. If I start using 10% of 98, the last value will exceed 103.92. This means that in this case we will have to calculate a revised effective rate. We will have to calculate a revised effective rate for the purpose of amortization. And this is the only case where we use the revised effective rate. In any other question, we are not going to use the revised effective rate. This is only used when we are reclassifying from fair value through P&L to the amortized cost category. Rashid is saying some things does not make sense. So, Rashid, can you be specific exactly which thing is creating a problem for you? Tahir Tariq is saying when to use effective rate for finance cost or when to use market rate. Tahir, up till now we have used the effective rate in the table everywhere. We have never used the market rate. We have used the market rate only once. Where we were calculating the present value of all cash flows in case of a compound financial instrument. Other than that, we have used the effective rate in all places. Ailera is asking, so what will be the new rate? Ailera, we will have to calculate the new rate using the IRR, which we have studied in F9, but that is not examinable in P2. You should be aware of this only theoretically. You will not be expected to calculate a new rate. Rashid Arif is saying that companies can reclassify for under or overstatements. Rashid, basically the under or overstatement is possible to some extent. Not entirely. For example, if you say that if the fair value would have increased, the company may change the intention and create a gain. But whether the intention is really changed or not, this work will be of the auditor to verify whether the intention has changed or not. This will not be a work of the accountant. The work of the accountant is that if the intention has changed, apply the accounting. Okay, so we are now left with 15 minutes for today's session. Anything left today, we will be covering it most probably by tomorrow. So don't worry about that if anything is left. We'll cover that tomorrow. So your feedback is important to us. Please provide your feedback for the today's session and the previous session. Anything that's good, anything that's bad, so that we also create a self-assessment of ourselves. So do provide the feedback at the end. Now let's move forward. So this is how the reclassification is to be accounted for. There's one more thing that you have to remember. That reclassification is only allowed when the intention to hold until maturity also changes. The reclassification is only allowed when the intention also changes, because in amortized cost, the intention should be to hold until maturity. And in fair value through P&L, the intention should be not to hold until maturity. Rather, the objective is to sell or to earn the capital gain. So, if our intention is changing, only in that case we will reclassify. If the intention is not changing, we will not be reclassifying. And if the question is silent, about the intention, whether it is changed or not, in that case, we will assume that the intention has not changed. If the question is silent, we will assume that the intention is not changed. Hassan Khan is asking that are we required to calculate the revised effective rate? No, Hassan, we just have to gain the knowledge that that a revised effective rate will be used. We are not expected to calculate that revised effective rate. Guang is asking, what if the company forced to change in its intention, such as facing difficulties? Yes, Guang, this is a genuine reason that if a company is in financial difficulty, the company wants to sell the financial asset that was carried at amortized cost, the company can reclassify. Okay, Subhash, I will be providing you the reference as well. Okay, now let's move forward to the derecognition of financial asset. In case of a derecognition of financial asset, normally what happens is our right to receive cash. Normally a financial asset is a right to receive cash. Either we will exercise our right to receive cash. If we are exercising our right to receive cash, the entry will be bank debit and financial asset credit. We had a right to receive cash and now we have received the cash. So the cash received will increase the bank balance, bank debit and financial asset credit. And if our right to receive cash is lapsed, expired, the time has passed, it will become a loss for us and the entry will be financial asset credit and P&L debit. Nabil is asking, so this is all about IFRS 9 with respect to exam course of P2. Yes, Nabil, we are discussing the entire IFRS 9 with respect to P2 exam. Anything that is not examinable will not be covered over here. So when our right will lapse, we will record it as a loss, P&L debit, financial asset credit. And if the right to receive cash has been transferred, there are two possibilities. Either the risk and rewards will also be transferred, or the risk and rewards will not be transferred. If the risk and rewards have been transferred, we will de-recognize the financial asset. If the risk and rewards have been transferred, we will de-recognize the financial asset. And if the risk and rewards are not transferred, we will not de-recognize the financial asset, rather we will create a financial liability. If the risk and rewards are not transferred, we will not de-recognize the financial asset. Instead, we will create a financial liability. Let's have an example for this. Now, we are applying the rules of de-recognition to factoring so that we can understand the rule of transferring the right to receive cash. What is factoring? Factoring is a case where company sells goods to its customers. The company sells goods to its customers and gives the right to receive cash to the factor. And the factor recovers the amount from the customers. The factor recovers the amount from the customers. This is the case of factoring. Now the question arises, who is going to bear the bad debt risk? Whether the company will be bearing the bad debt risk or the factor will be bearing the bad debt risk. And the accounting depends on that question. And the accounting depends on the question. Few people are asking me to go back onto the previous slide so that they can take the snapshot. So this is the previous slide, you can take the snapshot. Taken. Okay. So now the question was, to whom does the bad debt risk belongs? Now there are two possibilities. Either the bad debt risk may belong to the company or to the factor. First case, where the bad debt risk belongs to the factor. We also call this non-recourse factoring. Or we may also say without recourse factoring. So in this case, the risk and rewards have been transferred to the factor. So let's say that the company had sold goods of $100 million to the customers, and the company asks the factor to recover that amount from the customer. And the company also asks the factor to provide the cash to the company today, before receiving from the customer. And the company and the factor agrees that the factor will be paying the company 90 million and the factor will be keeping remaining 10 million as the factor fees and the interest on advance payment. The company and the factor decides that the factor will be paying 90 million, deducting 10 million for what? The factor fees and the interest on the advance payment. So what will happen in this case? The accounting will be, we will be de-recognizing the receivables by 100 million. We will be de-recognizing the receivables by 100 million. And we have received the cash of 90 million and the remaining $10 million will be recorded as an expense. This is the simple entry for factoring where the bad debt risk has been transferred. But if the bad debt risk had not been transferred and had been retained by the company, what would happen in that case? That the $90 million that we have received will be treated as a financial liability, because if this 90 million has not been recovered by the factor, the company will be liable to pay it back. The company will be liable to pay it back. Now, when the factor recovers the amount, what will be entry in that case? That At that point of time, we will be de-recognizing the receivables of 100 million, and we will be removing the liability of 90 million. And at that point of time, we will be recording the factor fees as an expense. So this is how we treat the entire factoring case. Okay. Now Tariq Mahmood is asking that revaluation reserve are absoluted this attempt to onwards change to control retained or control transferred. Okay. Tariq, the risk and rewards, you are saying that the risk and rewards have been transferred onto the control, whether it is transferred or not, but that is for IFRS 15. That is for IFRS 15. For IFRS 9, we still say that the risk and reward is transferred or not. Chandan is asking for any other example other than factoring. Okay, Chandan, I will be discussing this. Sibrat is asking, so we do nothing with the factor fee on recognizing the financial liability. Yes, Sibrat, we are not going to record the factor fee at this point of time, because for what are we paying to the factor? We are paying to the factor to recover the amount, and that has not been recovered yet. Therefore, we are not recording the factor fee at that point of time. Okay, we are short of time, moving towards the next slide, so that at least we can complete the de-recognition of the financial asset. Now we are applying the de-recognition rule onto sale and buyback agreements. The sale and buyback agreements can be of two types. Either the buyback price will be fixed, that for example, A sells goods to B for $100 million with an agreement that A will buy back these goods at 110 after 1 year. A sells goods to B for $100 million with an agreement that it will buy back the shares at 110 after 1 year. So in this case, there's an agreement where we are selling and then buying back, and the price is fixed. What will happen in this case is the amount received by A of $100 million will be treated as a liability, because A has to pay it back at the end of year 1, including the interest cost, which is of 10 million. So any amount above 100 is the interest, which is 10. So at the year end, at the first year end, we are going to record the finance cost of 10 million, and then we are going to increase the financial liability by 10 million as well. So where the buyback price is fixed, we say that the risk and rewards have not been transferred. Therefore, the amount received is a financial liability. And if the buyback price is the fair value, there is no price agreed by A and B, only it is decided that A will purchase the shares back after 1 year at the fair value. In this case, we say that the risk and rewards are transferred. So the case where sale and buyback agreement has a buyback price which is of fair value, what we do is that we will record the bank at $100 million, the amount that we have received. The asset will be credited by the carrying amount, whichever it is, 80, 90, 95, 100. And the P&L will be the balancing figure as the gain or loss on disposal. So this is how sale and buyback agreements are treated, and this is also one of the examples of the de-recognition. So I'm repeating it once again. If the buyback price is not fixed and it is the fair value, what will happen is that the risk and rewards have been transferred to B, because if the fair value decreases after 1 year, B is at a loss. And if the fair value increases after 1 year, B is at a gain. So the risk and rewards belong to B. Therefore, what we do is that we will be crediting the financial asset, we will be de-recognizing the financial asset at its carrying amount, which may be 80, which may be 90, which may be 100, with the balancing figure being treated as a gain or loss in P&L. Yes, Ailana, buyback is not optional. In this case, it is compulsory right now. according to the example that I have taken. Guang is asking a question that may I know the derecognition lapse P&L refer to what? Guang is asking about a previous slide over here, that by lapse we mean that our right has been expired. So that will be treated as a loss in P&L. Where the right has been lapsed, the loss will be taken to P&L symbol. P&L refers to the loss basically. Nabil is asking, can you tell the past papers for practice purposes? Nabil, the past papers are already attached in the presentation that have been shared with you, so you can refer to those past papers, and we will be probably solving them tomorrow as well, so it will be more beneficial for you. Tahir Tariq is asking that, is this all about factoring, as I performed some question having difficult entries? Yes, Tahir, this is all about factoring. You can send the questions on the WhatsApp group of the webinar, so that if there is something additionally difficult, in that case I will try to cover in the next class, although there is no any such thing. Akib Yusuf is asking, can you explain the case of fixed price? Okay, so this is the last question that I'm taking because we are already over time. So where the price is fixed, Akib, where the price is fixed, for example, the price is fixed at 110. So in this case, B has no gain or no loss because of the movement of the price. If the price increases after a year, B will receive 110. If the price decreases after a year, B will receive 110. So B will have no benefit or no reward of increase in the share price, nor any risk because of the decrease in the share price. So when the price is fixed, we say that the risk and rewards have not been transferred. So the amount received by A of $100 million is a financial liability which A has to pay after a year along with the interest of $10 million. So this is the case of the fixed price. So you people can join the WhatsApp group. The link has been shared with you people. If there is any problem in joining the link, you can contact me on my WhatsApp number. And thank you so much for today's session, and we are completing now. And thank you so much, Akib Yusuf, for calling me a Superman. That's a pretty good compliment. Thank you, everyone, and hoping that the session was useful to you all, and it will be beneficial for you in passing your exam as well. Looking forward to see you tomorrow. Thank you so much.